Hi, I'm here with Isla Vancouver Wealth Management. This week, I was reminded that while history doesn't repeat itself, it often rhymes. And I came across a very interesting piece, an editorial written by Warren Buffett, the Oracle of Omaha, considered by many as the greatest investor who ever lived, the chairman and CEO of Berkshire Hathaway. Um, this piece was written in 2008, right in the middle of the great financial crisis. And even though it has a very definite American focus, the principles expressed by Warren Buffett in this piece could be very well applied to our Canadian context or a global context. And that's why I would like to read it to you. Let's take a look. New York Times, October 17, 2008, op-ed contributor, Buy American, I Am, by Warren E. Buffett, Omaha. The financial world is a mess, both in the United States and abroad. Its problems, moreover, have been leaking into the general economy, and the leaks are now turning into a gusher. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary. So, I've been buying American stocks. This is my personal account I'm talking about, in which I previously owned nothing but United States government bonds. This description leaves aside my Berkshire Hathaway holdings, which are all committed to philanthropy. If prices keep looking attractive, my non-Berkshire net worth will soon be 100% in United States equities. Why? A simple rule dictates my buying. Be fearful when others are greedy, and be greedy when others are fearful. And most certainly, fear is now widespread, gripping even seasoned investors. To be sure, investors are right to be wary of highly leveraged entities or businesses in weak competitive positions, but fears regarding the long-term prosperity of the nation's many sound companies make no sense. These businesses will indeed suffer earnings hiccups, as they always have, but most major companies will be setting new profit records 5, 10, and 20 years from now. Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before sentiment or the economy turns up. So if you wait for the robins, spring will be over. A little history here. During the Depression, the Dow hit its low 41 on July 8, 1932. Economic conditions, though, kept deteriorating until Franklin D. Roosevelt took office in March 1933. By that time, the market had already advanced 30%. Or think back to the early days of World War II, when things were going badly for the United States in Europe and in the Pacific. The market hit bottom in April 1942, well before Allied fortunes turned. Again, in the 1980s, the time to buy stocks was when inflation raged and the economy was in the tank. In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked down price. Over the long term, the stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu pandemic, and the resignation of a disgraced president. Yet the Dow rose from 66 to 11,497. You might think it would have been impossible for an investor to lose money during a century marked by such an extraordinary gain. But some investors did, The hapless ones bought stocks only when they felt comfort in doing so, and they then proceeded to sell when the headlines made them queasy. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Indeed, the policies that government will follow in its efforts to alleviate the current crisis will probably prove inflationary and therefore accelerate declines in the real value of cash accounts. Equities will almost certainly outperform cash over the next decade, probably by a substantial degree. Those investors who cling now to cash are betting they can efficiently time their move away from it later. In waiting for the comfort of good news, they are ignoring Wayne Gretzky's advice. I skate to where the puck is going to be, not where it has been. I don't like to opine on the stock market, and again I emphasize that I have no idea what the market will do in the short term. Nevertheless, I'll follow the lead of a restaurant that opened in an empty bank building and then advertised, "Put your mouth where your money was." Today my money and my mouth both say equities. Warren E. Buffett is the chief executive for Berkshire Hathaway, a diversified holding company. And he's 94 years old now. But these statements ring true today. Please talk to your financial advisor. I'd be happy to talk to you. Please subscribe, and I will see you soon.